Stock valuation, the dividend discount model. John is sitting in his glass-walled office, staring at a flashing green number on his computer screen. The ticker symbol for STCK, Stickman keyboards. Since going public, John has become obsessed with one question. What is a share of my company actually worth? The market says it's worth $50 today, but is that a fair price, a bargain, or a bubble waiting to burst? To find out, John realizes he can't just look at the flashing lights of the stock exchange. He needs to go back to the fundamental truth serum of finance that he learned in the very beginning, the present value. Only this time, instead of valuing a single keyboard or a fixed bond, he is valuing the infinite potential of a living, breathing corporation. As Brealey, Myers, and Marcus explain, the value of a stock is no different from the value of any other financial asset. It is the present value of all the cash flows that the owner expects to receive. For a bondholder, those cash flows were fixed coupons. But for a stockholder like John, the cash flows come in the form of dividends. This leads to a profound realization. A stock is worth the discounted sum of every single dividend it will ever pay from now until the end of time. John scratches his head. But wait, he thinks, I'm not going to hold this stock forever. I might sell it next year. He remembers the book's explanation of the investment horizon. Even if John sells his stock in 12 months, the person buying it from him will only pay a price based on the dividends they expect to receive in the future. Therefore, the current price is always a reflection of the total future dividend stream. Whether you hold it for a day or a century, the value is anchored to those future cash payments. To make this practical, John uses the dividend discount model, or DDM. In its simplest form, the value of a share today, P0, is the expected dividend next year, div1, divided by the difference between the investor's required rate of return, R, and the expected growth rate of those dividends, G. This is the famous Gordon growth model. The current stock price equals dividend 1 divided by the difference between the required rate of return and the growth rate. John decides to test this formula on his own company. He expects Stickman Keyboards to pay a dividend of $2 per share next year. He knows that his investors are a bit cautious, so they require a 10% return, where equals 0.10, to compensate for the risk of the keyboard industry. Finally, John estimates that his company's profits and dividends will grow at a steady 6% per year, where G equals 0.06 as he expands into new markets. When John plugs the numbers into the formula, $2 divided by the result of 0.10 minus 0.06, he gets a result of $50. He smiles. The market price and his calculated intrinsic value match perfectly. He now understands why the stock price moves. If John announces a breakthrough in AI-powered keyboards that increases the growth rate from 6% to 7%, the denominator in his formula gets smaller and the stock price shoots up to $66.67. If, on the other hand, the central bank raises interest rates and investors start demanding a 12% return, the denominator gets larger and the stock price crashes to $33.33. John realizes that a stock's price is a delicate balance between greed and growth, risk and reward. The required return, R, represents the hurdle the company must jump over, while the growth rate, G, represents the engine pushing the company forward. This also explains why some young, high-tech companies have massive stock prices even though they don't pay dividends yet. Investors expect that these companies will eventually become cash cows that pay massive dividends in the future. The value is still based on dividends. They are just deferred to a later date. But John also sees the danger in the math. If the growth rate, G, ever gets too close to the required return, R, the formula starts producing nonsensical, infinite values. This teaches John a vital lesson. No company can grow faster than the overall economy forever. He must be realistic about his growth expectations. High growth is usually temporary as competitors move in to steal his keyboard crown. Finally, John looks at the total return he is providing to his shareholders. He sees it has two distinct parts. First, there is the dividend yield, the $2 dividend divided by the $50 price, which is 4%. Second, there is the capital gain, the 6% growth in the stock price itself. Together, these two parts equal the 10% total return his investors expect. John closes his laptop and looks out over his factory. He no longer sees his stock price as a random number or a gambling chip. He sees it as a mathematical expression of his company's future potential. By mastering the dividend discount model, John has moved beyond the hype of the market. He knows that at the end of the day, a company is only as valuable as the cash it returns to its owners over time. He is no longer just a builder of hardware. He is a builder of cash flows, and he knows exactly how to measure the value of the empire he is creating. The fog of the stock market has cleared, and John is ready to lead with the clarity of a true financial architect.